Join us right now to talk some internet stocks ahead of the holidays here. Mark Mahaney, Evercore ISI, head of internet research. Good morning to you, Mark. You know, we've been talking about how basically the entire market has just continued to fly. And the question, of course, is how much more does it have to fly? Whether you think a pullback is in the offing, and if you don't want to market time it exactly, what's the right move here?
Okay, well, you're right, Andrew, that we've had a pretty big rally in especially the highest quality internet names. There's very little dislocation now. We've got stocks like Netflix and Meta and Spotify that are close to all-time highs or have been knocking on all-time highs in the last couple of weeks. So there's not that many new opportunities in there. We continue to like Amazon for one of the reasons you already talked about earlier on the show, which is what I think is going to be an inflection point in ad revenue. And then we particularly like Uber here. It's actually one of the few, maybe the only high-quality internet stock that's dislocated. So those would be our two top picks going into the end of the year.
When you say Uber is dislocated, let's look at it right there. You're saying it's come down from its high. Is that what you're suggesting?
Yeah, and there's two reasons. The stock's corrected something like 20%. It's dislocated for two reasons. These concerns over what happens to Uber in the robo-taxi world. And then there's the concern over this last quarter, the print. We had some deceleration in what they call the mobility bookings, the rideshare bookings. And there's a concern that that's going to continue on into next year. I think both of those concerns are overstated. I'm taking the other side. That's why it's our top pick. I think as the largest demand aggregator for ride sharing, I think Uber is going to be a positive derivative. I think it's going to be a winner off of robo-taxis. I think we're going to see more Waymo business deals with Uber that are consistent with what they've already announced in cities like Atlanta and in Austin. And then on the mobility side, I actually think that the comps get easier going into next year. I think the product continues to improve, things like Uber for Business, Uber for Teens. So I think the growth rates for Uber's mobility business can actually stabilize going into next year. It'll probably stay close to 20%. I think that's good enough to take the stock materially higher from here.
Materially higher is what?
Oh, a 30-40% upside. I mean, you put 25 times free cash flow on an Uber, and you could easily get 50% upside from here. It's a high quality asset. Free cash flow margins are ramping, and I think you'll see them aggressively start leaning into buying back stock. You got all the makings here of a really nice outpacing stock.
How do you think about Lyft, by the way, in all of this? They've actually done quite well recently.
The stock's done well. They've started to execute a little bit better. If Uber was at an all-time high and trading at a 25 times free cash flow multiple, I'd probably look and lean into Lyft. But for now, I can sort of look at the largest, best situated, most globally diversified, most product diversified, gig economy play. That's Uber, and I can buy it at what I think is a really great discount. I don't see the great need to step into Lyft.
Let me ask you a different question, which is we've talked about Apple over the years, and we've now been having a big conversation about what tariffs might look like, in this new administration. Tim Cook has done a great job somehow with his relationship with Donald Trump. That was actually reported about in the Wall Street Journal earlier this week. Do you have any anxiety that either an Apple or any of the other big tech companies are going to be impacted by tariffs from China?
Well, absolutely. If you're any sort of retailer is going to have to worry about that. So, that's Walmart, obviously, and it's Amazon, obviously. There's a very high percentage of products sold on Amazon that come via China. So something like, some broad, flat out further imposition, I should say, of tariffs that could cause cost pressures, price pressures for people shopping at Amazon. It could cause people to pull back from shopping at Amazon. I don't think Amazon would be competitively disadvantaged versus other large retailers. I just think across the board, it could be an issue. It would be an issue for retailers.
And then finally, Mark, do you expect that some of that pricing pressure gets taken by an Amazon or gets taken by a Walmart or not?
I don't know, Andrew. I would guess that it would be a mix here. So the companies would have to make that decision. Do they pass it on, or do they and then dent sales growth, or do they take on some of that and suffer lower margins. My guess is that these companies would probably do a mix of these things, and they've been hedging themselves for. This isn't the first time that they've had to deal with tariff issues over the last 6-8 years, and so they probably have decent playbooks, but it's probably going to be a bit of both. It's an issue for any retailer that sources from China, which is almost any retailer in the U.S. Tariffs are an issue.